Good afternoon, ladies and gentlemen. Welcome back to this week, a weekly market review. We have just concluded the first week of the second half of 2024. As usual, I have with me today Mr. Gerald Wong. How are you, Gerald?
Morning. Had a very busy first week of the second half of the year, very busy weekend as well. I think just in 1 week, we have seen quite a lot of movements in global stock markets, and we are now heading into the start of the first half report season. So quite a number of things to update and share with our viewers today.
Yes, I am pretty encouraged by how the first week of the second half of the year has concluded. We see that Nasdaq is up over 3% and the S&P 500 up over 2%, and we are at record close, record high again. So I'm very upbeat about the second half of the year, and then anticipating that the rate cut will come in September. And I believe you will be going through a lot of these details with us today, Gerald.
That's right. Yep. So before we dive into it, just the usual disclaimer that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming Ask SIAS on the 17th of July. This is free and exclusive for members of SIAS. So if you're a member, you can register by scanning the QR code here. The registration will close on 15th of July. Okay, if you find our weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to this website, and the membership for SIAS will cost $12 per year or $1 per month. Okay, so as Sunny mentioned earlier, we saw quite a bit of movement in the US markets. We saw that the S&P 500 was up by 2%. This was led by gains in the US tech stocks, which saw a gain of 3.4%. Okay. Singapore, the STI continued to do well with a gain of 2.3% in the past week alone. So this actually exceeded the gain of the S&P 500 once again. Okay. Okay, what is driving the bounce in the market? We see that we have the latest US payroll data that was out. What we see here is further signs of softening. So in the month of June, there were less jobs created compared to the month of May. But at the same time, we saw that the April and May numbers were revised downwards. So this provided some signs that there are some indicators of softening in the US labor market. On top of that, we saw that the unemployment rate in the US went up to 4.1%. Fed Chairman Jerome Powell also indicated that the Fed is making progress towards having inflation being controlled. So all of it is actually driving investor confidence that the Fed will start to cut interest rates soon. Okay, so this is what we see in the US government bond yields. There was a sharp fall in the past week, okay, from above 4.4%. We see that it's come down to about 4.28% just in 1 week. Okay, so all of it is due to the fact that investors are now gaining confidence around potential rate cuts. Okay, this is what we see in terms of the expectations on the upcoming September Fed meeting. Okay, currently the Fed benchmark rate is at 5.25 to 5.5%. But what we see here is that the probability of a September rate cut has increased over the past week. Okay, from about 60%, it is now above 70%. Okay. So the latest data points that are coming out is actually driving increasing investor confidence that we'll see the first rate cut coming through in September. Okay, so in summary, this is the latest expectations on the interest rates according to the CME FedWatch tool. Upcoming meeting in July, expectations is still for rates to be kept unchanged. September, we see that there's now a 72% probability of a rate cut, and this is followed by potentially another one in December this year, which will bring the total number of rate cuts to 2 this year. Okay, so this number is what we'll continue to keep a lookout for, whether we see higher conviction towards a September rate cut, and this will potentially be something that investors will use to estimate whether we will see more upside towards the global stock markets. Okay, now we'll move closer back to home to look at the top gainers and losers in the STI. In the past week, we saw that the banks continue to do very well. Okay, DBS with a 4.6% gain, OCBC 4%, and UOB 3.7%. So with this, we see that DBS and OCBC has reached an all-time high in terms of their share price performance, and UOB's share price is at a 2-year high as well. Okay, in terms of the worst performers, we see that some of the consumer-related stocks are having a bit of a pullback. DFI Retail Group down by 2.6%, Genting Singapore down by 2.3%, and Thai Beverage down by 2.2%. Okay, Yangzijiang Shipbuilding having a bit of a pullback as well after the stock reached a 52-week high just a week ago. Okay, so next I will do a recap around what are some of the top performers of the STI in the first half of the year. So earlier I shared that while Yangzijiang has pulled back slightly, this is after the stock has gained by 65% in the first half of the year alone, making it the top performer of the STI in the first half of the year. Okay, outside of that, we see that the Singapore banks have made significant gains as well. DBS with a gain of 19% in the first half, OCBC with a gain of 12%. Okay, next rounding it up, we have Singtel and ST Engineering, and all of these 5 stocks actually outperformed the STI. We saw a gain of 3% over this period. Okay, so what I'll do is to do a quick recap around some of these company developments to understand why they have actually performed so well. Okay, we start with Yangzijiang Shipbuilding. This is a stock that has been a very strong performer, and a lot of the strong share price performance is driven by its order momentum, where we see that they have continued to win very significant orders. So in the first few months of the year alone, they have won $3.3 billion worth of contracts. And with that, they have actually achieved already 74% of their 2024 target of 4.5 billion of orders. Okay, so we see that they are winning a lot of orders, and this continues a trend from 2023, where they won 7 billion of orders in the previous year. Okay, what is driving these orders? We see that across quite a number of the different vessel types, the demand is actually fairly strong, particularly in the segment of oil tanker as well as gas carriers. Okay, so for LNG carriers, LPG carriers, we are seeing that because of the global energy transition, there is a very strong demand for these gas carriers. Okay, next we'll move on to Singtel, another very strong performer. And for Singtel, the driver of the strong bounce in the share price is really driven by the Singtel 28 strategy that they announced about 2 months ago. So previously, they had the strategic reset transformation, where they laid the foundation towards operational improvements as well as a capital recycling program. Okay, but with Singtel 28, which is their latest announced strategy, they want to be able to drive sustained value realization. And this is really done through improving the business performance further, as well as improving on the capital management. Okay, so in terms of the capital management, what they've also announced is a new dividend policy, okay, which includes a core dividend, which is between 70% and 90% of the underlying net profit after tax. But at the same time, they've also announced a value realization dividend. This will amount to 3 to 6 cents per share annually. It'll be funded from current excess capital, as well as any potential excess capital that will be generated from their asset recycling pipeline, which amounts to 6 billion. Okay, so this is now embedded into their dividend policy, and what they want investors to be thinking about is that this is something that can potentially be recurring rather than a one-off. Okay, next we've got ST Engineering, another one of the top 5 performers in the STI, where we see that the revenue has actually grown significantly in the first quarter of the year, with the growth driven by a very strong recovery in the commercial aerospace segment. Okay, so the global bounce in air travel is driving greater demand for their maintenance, repair, and overhaul work for commercial aircraft. And that is driving the very strong increase in the revenue in the commercial aerospace segment in the first quarter of this year. Okay, with that, we have seen ST Engineering having an increase in its order book as well. Okay, so earlier we saw that Yang Zhejiang has achieved very strong orders. We see that for ST Engineering as well, where the order book has grown from 19.3 billion at the end of 2021 to 23 billion at the end of 2022 and at 27.4 billion at the end of 2023. Okay, so this number has continued to grow in the first quarter of this year, and they are now at the level that is close to 28 billion in terms of its order book. Okay, last but not least, I will touch on the bank, since this is a topic that many investors have been noticing, especially with the share price of DBS and OCBC now at an all-time high. Okay, so DBS at above $37 per share. This is after adjusting for the bonus share issue that we saw earlier this year. And OCBC also at an all-time high of $15 per share. Okay, so what is driving the bounce in the bank's share price? A lot of it is driven by the higher for longer interest rate environment that we are in. So we have seen the delays in the Fed rate cut, which is driving better net interest margins for the banks. Okay, so for DBS, what we see is that if we were to look at the first quarter, the net interest margin actually bounced from the first quarter. And for OCBC, the net interest margin has been fairly stable at 2.27%. Okay, so we see more signs of stabilization in the net interest margin of DBS and OCBC compared to UOB, where we have seen some slight deterioration over the past year, which is why these two stocks have done better than UOB. Okay, but even with the slight decrease in net interest margin for UOB that we see, it is still able to generate very strong returns, which is why the share price is also at a 2-year high. Okay, so with that, we have seen an improvement in the returns that are generated by the banks. DBS ROE in the first quarter was at an all-time high of 19.4%, and OCBC 14.7% ROE in the first quarter, which is very strong as well. Okay, so you might be wondering at this point in time, given the strong rally, what is the dividend yield that we are looking at for the Sing banks? So I've updated this chart yesterday. For DBS ROE, dividend yield of 5.8%, OCBC 5.6%, and UOB now at 5.2%. Okay, so the dividend yield is still higher than what we see for the STI. So that is something that we'll continue to keep a lookout for in terms of whether we'll see this dividend yield being sustained. Okay, so I've done a recap of the 5 best blue chip stocks in the Singapore market in the first half of the year. We are now in the second week of July, so quite a number of things to keep a lookout for. On the macro front, we have the US inflation data that is coming out, which will provide investors with more signals around whether the September rate cut is coming true. We're also starting with the earnings season in the US, with JP Morgan and Citi reporting their first half results on Friday, the 12th of July. Okay, so with that, I'll hand over to Sunny, who will share with us how the technical indicators are looking like now.
Hey, thanks, Gerald, for that very detailed sharing on what happened in the first half of this year. We are all very much looking forward to the second half. Of course, Gerald shared earlier that this week we are looking at the CPI data, which will be front and center of what investors will be looking at. We also have the earnings season starting soon, starting with the US banks. That's the traditional customary process that we go through. In Singapore, we are also going to see the bank's earning coming out in the next few weeks, which is the first week of August, I believe, if I remember correctly. So I think that results, that earnings could probably be another leg of bringing up the STI and the banking stocks in Singapore. So do look out for that. On the charts now, I'm seeing that in the early Monday morning trade, STI is slightly a bit negative, down about 4 points. This was after the 2.3% gain that we saw last week. So it's not a surprise to see that STI having a slight pullback now after it has reached the upper bound of the Bollinger Band, which is above the 3,425 points level. Last week, we actually touched a high of 3,442 points on Thursday. And this is a level we have not seen since the year 2022, February 2022 period. So we are going to be closing in on the 3,500 mark towards the end of the year. But for now, I think what the indicators are telling us on the STI is the index is a bit stretched right now. We can see that the MACD in the past two trading sessions, including today, Monday, the momentum is coming down slightly. So there's a subsiding of the uptrend momentum that we are observing. And the RSI has already breached the 70-point overbought level last Thursday as well, and it's now coming back down with the latest reading at 65 on Monday morning. So that means that we might see a bit of a pullback on the STI index, but that does not mean that the rally that we see in the first half is going to stop. It's likely going to be a slight pullback before we get a rebound again. So a pullback towards the 20 days moving average, which has always been tracking very closely where the index has been moving, will not be a surprise. And that 20 days moving average right now, which is the black line that you see here, is around the 3,340 points level. So that would be a key level to watch. When STI pull back to this level, it could mean that it is time to accumulate again. Okay. Of course, other reference level, you can look at the EMA 20 days, exponential moving average 20 days at 3,350 points level, and also the 50 days moving average, 50 days exponential moving average, which is the blue line, and that is now at the 3,317 point levels. So for me, I think the STI index, once it pulls back towards, on average, the 20 days moving average, which is 3,340 or below, that would be a point that I will start to accumulate the STI index again after identifying the low on the 20th of June period. Okay, so that's my take on the STI. Wait for a pullback before we accumulate further on the STI index for the second half of this year. Next, let's look at the Dow Jones Index. Okay, so the US indices, you can see that among the three US indices, Dow Jones is the lagger. Because the rally that we have seen so far this year were mainly led by the tech stocks. But as Gerald shared earlier, we are going to see the earnings of JP Morgan and Citi this week, this Friday. And I believe that results will definitely be a positive result as well. And that could bring up the Dow Jones Index as well towards the year-to-date high at 40,077 points, which is something that we saw in the May period. So looking at the indicator-wise, you can see that the MACD indicator, the MACD line and signal lines are pretty flat right now, meaning there's not much of a momentum in the Dow Jones Index right now, though the reading is still slightly positive. So that means that there is a little bit of a positive momentum inside the Dow Jones Index right now. On the RSI, we also have a slightly above average positive reading, which is above the 50-point neutral mark. The latest reading last Friday at 59 points showed that it's 9 points above the 50-point neutral mark, meaning also it concurs with what the MACD is saying. There's a slight positive momentum in the Dow Jones Index. And with this slight momentum, it will still be trading within the range of the Bollinger Band, and hence it has not really challenged or break above the upper bound of the Bollinger Band, now at 39,511 points. So where should we look at some of the key level of support for the Dow Jones Index? That includes the 50-point moving average, which 50 days moving average, which is the blue line, and that is around the 38,957 points level. Or if you round it off, that is the 39,000 handle that we should be looking at. And just slightly below that, you have the amber line here, which is the 100 days moving average, which proved to be a very strong support and rebound for the Dow Jones Index during the April as well as the May and June period, as you can see over here. Once it starts the amber line, there is a sort of a very strong rebound happening. And that is that amber line, the 100 days exponential moving average is now at 38,587 points, coinciding with the lower bound of the Bollinger Band at 38,515 points. So this will be a very strong level to accumulate for the Dow Jones Index. Okay. Next, let's move to the S&P 500 Index. So needless to say, we are now in uncharted territory for the S&P 500 because we have an all-time high. We have a record close right now. So it is very difficult to predict how high will the S&P 500 goes further into the second half of the year because we don't have a precedence level to target anymore. But looking at the indicator, you can see that the MACD is sort of also at a very peak kind of a level, something of a MACD formation that you see in the first half of this year, where you can see the MACD line and swing line were always at the top side of the MACD indicator. So if MACD indicator were to remain at this level, then it would mean that the rally is likely going to continue. However, if there's a pullback, then that's something that we need to watch out for. That means once the MACD reading goes into a negative number, we need to be on high alert. And if there's a divergence of the MACD line away from the signal line, that would mean that the rally that we've seen so far is likely going to take a pause or a breather for now. Okay, but so far I have not seen that because the MACD indicator is still positive as of last Friday. On the RSI, we have already breached the 70-point overbought mark. The latest reading at 76 means that we are in overbought territory now, which also means in general terms, we might see a sort of a technical pullback very soon, because every time that we touch this level, the indicators or the RSI will usually start to have a bit of a pullback, at least towards the 50-point neutral mark, which is what we observed in the first half of this year. Okay, so if you're asking me, should you be going into the S&P 500 now? I think as a trader, I would rather not chase the stocks or chase the index. I would prefer the index comes to me. And if we are waiting for the index to come up to a comfortable level that we are looking to get back into, then of course the 20-day moving average at 5,452 points could be one level that we should be looking at, and that is 100 points away from last Friday close for now. On the lower bound of the Bollinger Band, as well as the blue line that you see here, that is the 50 days exponential moving average, now around the 5,340 points level. So that could be another level to look at to get back on the S&P 500 index. So for now, I'm waiting for it to pull back at least towards these two levels before I think of accumulating on the S&P 500 index again. Lastly, let's look at the tech-heavy Nasdaq Composite Index, which was up more than 3% last week. You can see the very strong momentum that we observed in at least the last 4 trading sessions. So that means that the Nasdaq Composite Index has now breached the upper bound of the Bollinger Band already, and it will not be a surprise if we see a sort of a technical correction, a technical pullback soon. So key levels to watch: 20 days moving average on the Nasdaq Composite Index will be around the 17,699 points level, or even the 50 days exponential moving average, the blue line, which is now at the 17,140 points level, with the lower bound of the Bollinger Band close by at 17,078 points level. So these are some of the key levels that we should with having some point of reference to get back on the rally of most of the indices, the 20 days and the 50 days moving average. On the indicator wise, we still have a positive reading from the MACD indicator. So that means there's still positive momentum, though we don't have any upside targets to reference now. But the momentum is still positive, meaning that the rally is likely to continue further. And the RSI has reached the 70-point mark, latest reading at 75. We had a highest reading of about around the 79 points level in June. And that would be the highest year-to-date reading on the RSI that we have so far. So that means there's still a little bit of space for the Nasdaq Composite Index to go slightly higher. But I believe the high right now is the risk and reward ratio might not be in your favor if you are going right now. So I would prefer a pullback towards the 20 days, which is around the 17,700 levels, or even the 17,100 points level, which is the 50 days moving average or the lower bound of the Bollinger Band, to consider another re-entry into the NASDAQ Composite Index. So that is all I have to share on the indices today. We have a very, very busy week, the next few weeks and the next few months going into the earnings seasons. Anything we should be looking out for, Gerald?
Yeah, so I think the key is really the inflation data that's coming out this week. Given that investors are now fairly confident of a September rate cut, which is actually in 2 months' time, I think that will effectively provide us a signal as to whether it is going to happen or not.
Yes, and on top of that, we will be, of course, updating you with the latest earnings results as we move into the earnings seasons. And that will be another driver, another catalyst to see how much that can push our index or even the major US indices going forward towards the second half. And I think that is the time that we have for this weekly market review. So in the meantime, remember to trade safe and stay safe, and we'll see you again next Monday in the next weekly market review. Goodbye.